Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, February 3rd, 2026. It is 12:22 p.m. Eastern Time as I'm starting the video. This is video number 2 of the day, and I just wanted to cover kind of an eclectic mix of some of the things I'm watching, um, and we'll go from there. So I'm going to start out here with this chart. I've shared it many times in the past. It very, 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 very much plays into my longer term outlook of the for the financial markets, especially my intermediate term outlook. What I expect to happen in 2026, and that is the next leg down. I think we got a shot across the bow last year, and even in 2022, we had a pretty good drop then, but either way, this chart it speaks for itself, guys. And these are, I try to choose my words carefully. Immutable is not necessarily the right word, but they are almost immutable um, conditions in the market, and that is it's the ebb and flow, the cycle of um, bullish and bearish sentiment, and then what happens when you have a prolonged uptrend and just about everybody in the mainstream media turns bullish, and most investors do. It's just evidenced by an increase in margin debt. That's very simple. What this is there's two types of brokerage accounts: cash accounts and margin accounts. Typically, most IRAs are cash accounts, meaning put a dollar in, you can invest a dollar. Typical brokerage accounts, unless you select otherwise, your broker is going to slip in a form called a rehypothecation agreement. I know this. I used to be a broker, and you probably signed it if you didn't pay attention. That allows your broker to take your stocks in your portfolio and turn around and lend them to somebody else to short. Um, and it also, the rehypothecation agreement will also allow you, it's called a margin agreement as well. You can then borrow against the collateral of your existing securities to buy more securities. And they can change that over time. I want to talk on that. That's why I'm doing this video. That's why I do these long-winded videos. Somebody asked a question the other day, and it kind of set me off in a tangential reply spree with 4 different replies of the same question. It had to do with margin, and I'm going to talk on that a little bit. And before I forget to tell you, if you haven't read about it, they've clamped down and increased margin requirements on silver. Silver was in a bubble. Of course, they wait until the bubble pops to do that. And then what happens is that tends to happen. The same thing's going to happen. That I can all but guarantee will happen sooner than later in the stock market based on this right here. And that is this surge in margin debt. So what that is, again, this is FINRA. It used to be NYSE. Now it's called FINRA margin debt. That's 1997. And, the cycles, they're predictable. You know how they say history doesn't always repeat, but it often rhymes. So in a bull market, margin starts going up, and towards the top, it starts to go parabolic. And that is because this is the dot-com bubble. It doesn't look like much because, again, this is using log scaling here. You can toggle that off on this particular chart. You can take off log scaling and see when it equalizes everything in dollar terms, because over time, remember, there's the debasement of the US dollar, and there's also an increase of debt. Our debt bubbles grow larger and larger and larger, and that's what, if you really take a step back and look at long-term charts, you can see the corrections in the bear markets. These little aftershocks are starting to get bigger and bigger. The Fed has supersized everything really since the financial crisis. But either way, let me turn back on the turn off log and just take a look at this. So that's was the final surge leading to the dot-com bubble. Remember, everybody back then, and I'm speaking, metaphorically, not literally, but just about everybody was chasing the dot-com names, just like they're chasing recently the AI or anything related to AI names for the most part. And then the bubble burst, and it was followed by a roughly 80% drop. And that's not a typo or misspeak. 80% drop in the Nasdaq, which was loaded with them. S&P fell less. I'm going to talk on that too today. A little bit about the S&P. I think it is time to. I think we're going to see a closing of the divergence between the S&P and the Nasdaq. I think the financials are ready to drop, and then that's going to add pressure to the S&P 500. You still usually get more bang for your buck in the Nasdaq, but I think the S&P may fall closer to what the Nasdaq falls on the next drop, big drop, next correction or bear market, whenever that is. So that's it. So you can see the pattern, and then these shaded gray lines. If you can't see, you probably need a new monitor. But they're there. The shaded gray areas that denote all the recessions. Again, the official recessions are declared by the NBER, who gets to use a very subjective measure. It's not the old, the gold standard forever and a day has been 2 contracting or negative quarters back to back of GDP. NBER uses their own, that's the National Bureau of Economic Research, their own qualitative or quantitative measures, however it is. And so you can see, then, bear market's over. You don't see the indexes here, but trust me, they overlap with this. And then new bull market. And what happened towards the top, it went parabolic. That's the dot-com bubble. I'm sorry, they call it the housing bubble, but it was an everything bubble back then. Credit was nilly-willy, and lending standards were extremely lax. And then that one burst, and then came the financial crisis, also known as the Great Recession 2, or what do they call it? The Great Recession. We had the Great Depression in the early 30s after the stock market burst and the bubble popped in 29, and this was known as the Great Recession. 55% drop in both the S&P and Nasdaq. That's where they both went down toe to toe, because remember, the banks were really the crux of the bubble back then. With their lax lending standards and all that, and all in on the housing market. And so therefore they fell right about it, roughly what the tech sector or NASDAQ did. And then that's it. They came in and supersized everything with massive, and that's when QE forever and zero interest rate policies kicked in, and all that liquidity that propelled stocks to where they were. In 2017, you had another peak followed by a correction. And then it troughed with the COVID lows right there. And then what happened when COVID hit? Well, all federal government, central banks around the world, they both panicked, hit the nuclear button. Cash for everybody. Let's just pump as much stimulus as we can. Unprecedented. Again, you can't even, it's hard to fathom the amount of money printing and both fiscal and monetary stimulus. And that just sent, it was creation of money. And so you saw it surge. Then we had a healthy bear market, which we traded pretty much with impunity back in 2022. Markets fell. Again, you're looking at just the margin balances there. And what it is, and if you're wondering why stocks fall so fast, why it feels like, just think back to, when Trump stepped up the podium. Remember, we'd already started the downturn. Felt like a henny penny scenario for a lot of people. The sky is falling, Chicken Little, and that kind of stuff. And what, stocks were in free fall, but that's because of this. And I've said this often, is one reason I love short selling, because stocks tend to fall much faster than they rise, or securities. And if silver isn't a great example of that, the other day down over about 30% total, I think, in a day or so. And so now here we are. What happened since then? They just hit the turbo button. And when I say everybody, again, I'm not speaking literally, but the masses believe everything's hunky-dory. The government, the data, which again is very suspect due to the government shutdown and the fact that it always has been lacking in a lot of places. But whatever, say what you want about the fundamentals. All I can tell you that we're looking at this right now. And this is the reality of it. This is a massive surge. And so I'm going to talk a little bit about more. It's not a matter of when the next real correction, solid 20% plus bear market, whatever you want to call it, comes. It's when it comes. This goes the other way. What I mean by that is selling begets more selling. As things drop and everybody's on margin, which is evidence here. This is not my opinion. This is fact. It's evidenced by this chart. And we saw the same thing in silver. People are loaded out to the hilt. It starts going parabolic. People are figuring, shoot, I'm making 10% a day in silver. It's going up 30, 40% a month, whatever it's doing. Why don't I just put more into it? Oh, I'm already maxed out. I don't have any spare cash. Oh, guess what? My broker's going to allow me to buy more silver than I actually have in my total account. That's margin. And so that goes the other way. And this is a stock market. So if you think Nvidia, think Alphabet, Google, think anything, Palantir just reported, all these stocks, and this big lift we had is not just natural buying. In other words, it's not just for every dollar somebody had, now they're fully invested. No, for every dollar you're giving your broker will let you turn around buy $4 of stocks. You go to futures, you can leverage it up much more than that. All right, so that's what that is. And once the turn comes, kind of just like the metals, as I said, when a parabolic bubble bursts, it doesn't end well. And like I said, what we saw the other day, whether Friday was all of it or a little more downside to come, there will be heck, we had a pretty nice bounce today. We hit my minimum, bounce targets I laid out for you this morning. But when this actually does pop, there are little corrections, but again, that didn't take out the previous peak. You can just kind of eyeball this chart. You don't have to be an expert technician to see this ramp up. You took out the previous high. It's kind of similar. Once you take out that previous high, that's where you go. The afterburner button is hit. The turbo booster is hit on the market. And that's usually what happens. And you can see also that we've gone nearly vertical, just like you tend to do into the end there. And just like silver and gold, I was saying this day after day after day. Be careful, just because something's going parabolic or, in a strong advance doesn't mean it must stop. And if you get in front of that train too early, you're going to get run over and hurt real bad, because some of the biggest gains come at the end. But once the turn comes, it's fast and furious. And again, my point I'm trying to make, it's a vicious cycle, because then selling begets more selling, as I often talk about. That same leverage that your broker gives you more than enough to hang yourself, but profit in a bull market, it goes the other way because they start calling in that credit, if you will, at the very worst time too, when you might have iron fist. You might be that one guy or gal that says, you know what, I'm silver. I saw somebody on their channel, I put somebody on there literally the day before silver crashed, that biggest drop in 40 something years. And they called silver to 5,000. All right, let's say you believe that. And let's say it is going to 5,000. You have iron fists and you're not going to let go of your silver come hell or high water. Well, you don't have it. If you've loaded up, if you're using it on margin, buying it on margin, you don't have a choice, because your broker is going to say, you either sell something or we're going to sell it for you. When I entered the field in the early mid 90s as a rookie stockbroker, that was T plus. Gosh, I think I'm dating myself. I think we were T plus 7, and then shortly after I got in, we went to T plus 5, meaning trade date plus 7 business days. I really didn't have, my clients weren't, I don't recall having to make a margin call, but back in that day, if you did, if a client had margin, your firm would tell you, this is Merrill Lynch I was working for, they'd say, yeah, Joe Smith has a margin call. You got to tell him to either, send you a check by mail, and that was fine. That was T plus 7. Everything was snail mail back then, or he can sell some stocks to cover that margin call. Or if the market turns around the next few days, everything's fine. Nowadays, most brokers, I know interactive brokers, they don't blink. You get a pop-up if you're on margin, they tell you you're out of violation. They'll blow you out, and sometimes in a matter of seconds, if not minutes, usually within almost certainly by the end of that day. And so therefore, I'm just, I do these videos in advance, and I talk this whole bearish talk of what may happen. It will happen at some point. And just don't be amazed how fast everything can fall because of that. It's a vicious cycle. Someone that put 100,000 in, loaded up on silver or Nvidia or whatever it is, it goes down. They get a margin call. A margin call is a forced sell. Either you do it or they will. When they sell, that selling then begets more to put selling pressure on the market overall. So other people's stocks are going down. Other people are getting the margin calls. And then the kicker is what I'm getting to. They tighten margin requirements at the very worst moment for those people. So that whole cycle that allowed the expansion, the stock market and these securities to get to such nosebleed levels, it goes the other way because the brokers have to protect their ass or they will blow up. They're also stretched, on margin, so to speak. And so if they're customers, because again, if you put in $100,000 cash and you bought $400,000 of silver or Nvidia, whatever it is, and all of a sudden let's say your portfolio just dropped. Let's say it went down 25%, right? That's not a big drop, right? 25%. I mean, it's not tiny. Well, guess what that is? 100% of your equity. You put up 100,000. You turned around, you bought $400,000 of what XYZ. It dropped 25%, which is a $100,000 loss. You went down to 300,000. Now you have zero equity in the account, and your broker's on the hook now. You're out. You're technically at that point you're bust. You lost everything you put in, but now your broker has a $300,000 loan out to you with no collateral. That's how that works, and that's how brokerages can blow up in this situation. So they have to then crank down the margin requirements to protect their own ass, and then by doing that, all of a sudden you say, oh, I wasn't running too tight. I knew I was well within my margin allotment. I had a little buffer in case my positions went against me. Now no longer, they just erase that buffer. Okay, so that's what happened in 2008, and that's what happened when the tariffs hit, and it's what's going to happen again, and it's going to happen bad at some point, guys. And I can't tell you if that started already. And, we won't know about it for a little while. We certainly haven't hit my lights out levels on the financials and some other stocks. But all right, that's it. Enough on that. You can pull this chart up, follow it yourself. I just wanted to point that one out. And then, so on a related note, it's a great question. I love these questions that come in. Again, hopefully this is value for others. Randy, is there any limit to the margin adjustments that can be made on futures contracts? Natural gas went crazy at one point, having a $120,000 margin requirement for one contract. Now it's $8,000. Remember, natural gas prices went wonky. That's a big cold snap that came through. If you live in the U.S., you're very familiar with it, or Canada was, we just got hit with some really cold weather. Got kicked out of my contract. So here's my replies. Let me rifle through these real quick. No, I believe not only do the exchanges have the power, and at times will, to change the margin requirements, which they almost do when volatility increase. Everything I just said. They're going to do it at the worst times, right? Which is when volatility goes up. So the exchanges can increase the margin requirements. So do the individual brokers, above and beyond what the exchanges require. In fact, it's about to get worse, at least for Interactive Brokers. They just sent this email, I'll go over that in a second, out to account holders a few days ago. That means they can, at a whim, and really with no predictability and no set formula or parameters for you to know how much they're going to change your margin by. So that, guys, this is the kind of stuff crashes can be led to, especially when you're at the levels. If we didn't have such excessive margin debt right now, as I just showed you on that first chart, that might not be a big deal. But when it is, again, think vicious cycle. Selling begets more selling. So they can, at a whim, change their margin requirements and blow you out of position that could have just temporarily moved against you just before the big run in the position you're poised for. Bottom line, make sure to allow a decent buffer regarding natural gas, and you can always use QG instead. It has the same, so I'm going to go over this in a second here. There's micro and mini contracts. It's MINY. It's I think from the NYSE, and they trade on the same exact chart. So I'm always going to use the main contracts, NG for natural gas. But if you use QG, which is the mini, it has a smaller leverage factor, but the same exact price. So the chart is the same whether I use NG. If you're trading QG, the price levels are all the same. The multiplier is just the leverage factor. You can read up on that if you understand how that works. And so I went on to list some of those. Where did I do it here? Anyways. So here's what Interactive Brokers said, if you want to read it. Just basically, starting February 4th, they're going to implement this new margin methodology that calculates the potential worst loss a portfolio can suffer in one day. So it's just a friggin' model, a new made up model that who knows how it works, only they do, and how accurate it's going to be. But basically, as volatility gets higher, it's probably going to crank down those margins on you. And so if you're running tight, and you may even have a pretty liberal buffer, but all of a sudden they can drastically change the margin on one of your positions, and suddenly you get a margin call. And again, they don't call you. Interactive brokers. When I started as a broker, I had to pick up the phone and call my clients. That's the protocol work. The broker call the client. Now it's just, everything's electronic, and it just their algos blow you out. And so it's portfolio dependent. So blah 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 blah. And here's the thing. Like, I'll use margin at times. I'm maxed out, but in a way that I will never like load up on all silver or load up only on short on the market. You guys know me. I love to do what I call indirect hedges. I also love to diversify. So by using margin to just load up on a bunch of tech stocks or a bunch of gold or silver, that's financial suicide. You're going to be very happy when your trade's going in your direction, and you're going to be very unhappy or just blown out or wiped out when it goes against you. But if you're using it to increase the amount of assets, uncorrelated assets or inversely correlated assets, they will look at that. They should be looking at that. That's usually what they do. I've dealt with this brokerage company for decades and had accounts with them. It's my primary trading account, and they typically will look at that. So for example, if you're short the indexes but long Treasury bonds, they understand, or their algo should understand, that there'll probably be a flight to safety bid. If the market starts to tank really hard, institutions are going to move in and buy Treasuries, and then that should be a somewhat of an offsetting position. But if you're short the semis via SOXX, and then you're short QQQ, that's a completely overlapping trade, and to them you're at more risk. All right, so, and keep in mind, so a lot of the trade ideas that I post on the right side of the chart are those with potentially explosive moves. Think silver, think natural gas, and out of those a lot. So again, know what you're trading, and know that those are the volatile ones that you're going to have to give yourself a little bit of more room. And you don't have to I always say that too, you don't have to put a lot into a trade that has a potential to do a quick 1 day or 1 week 30% gain. And then I went on to say, finally, many of the more liquid futures contracts have a smaller clone version with smaller multipliers. So for example, natural gas is QG, silver you have SIL, gold you have MCG, NASDAQ 100, which are MQ, you have MNQ, the Russell 2000, which is RTY, M2K. I could go on and on and on. The ES is the S&P 500 futures. I think it's MES for the little contract. And you can do a quick Google search to find those. In that way, instead of having one contract of NG, you can have two contracts of QG and then sell one or whatever. Look at the multipliers if you need to, or get blown out of one if they're going to hit you with a margin call. But again, I'm not giving anybody advice, telling anybody to use margin. Because I know a lot of people don't use it the way it was initially intended for, at least the way I view it. It lets you kind of diversify more and have more positions, especially with a more diversified portfolio. All right, so update on TOT. Okay, that's just me rambling fundamentally about Treasury bonds. I told you it's the one trade I'm cheering against because I have short the equity markets, and so I threw out an objective long entry on Treasury, so TLT a while ago. But it would greatly help the short case if Treasury yields continue to rise, which means bonds go down. But here's the long end of it is, why the long bonds going up. And again, I've talked on that repeatedly, that the Fed has lost control of the yield curve starting last year when they did their first rate cutting cycle. Started with a bang, 50 basis points. And instead of rates going down like they usually do and have in the past, they did the exact opposite. And that's what we call losing control of the yield curve. They can take short-term, as they tried, they kept cutting short-term rates each and every time. And what happened? Long-term rates did nothing but go up. They started here again with the same thing. They said, oh, this was a uh-oh, kind of a WTF moment for them. So they cowed down, they stopped, and they waited a year and they started cutting again. 1, 2, 3 back-to-back rate cuts. Not as drastic, but yet still the same result, going up. And then this is a lights out level here and here. Those are your multi-year highs back in late 2023 and 2025, but they're not just if Treasury, this is the 30-year bond yield. If it breaks out to a new multi-year high, as I've been saying, it not only does that, it goes to a multi-decade high. This is that. It zoomed in. These are those two highs in recent years. This is a long-term chart going back, 40 something years. And and this is my expectation. I don't know when it'll happen, but when it does, it should be lights out for the market. So that's going to take yields. As I take this arrow straight across, it's going to take yields back to levels not seen since the early 2000s and even the late 90s right there, right? And there is no way in God's green earth to spin this if that happens. And we're only in relative what I call spitting distance of doing that. There's no way to spin that as anything but bearish for the stock market and the economy, especially if the 10-year breaks out as well. The 30-year, 10 years really the one that mortgages are pegged closer to, and a lot of business loans are closer to the, around the 5, 7, 8, 10-year mark. But that's the same net thing. We're relatively within spitting distance of breaking those multi-year highs, which also take us back to yields not seen as far back as the 90s right there. And this was our secular bear market in interest rates, something I've maintained that I don't even think it's debatable that was the rocket fuel for the super duper bull market. And this was the all-in kind of moment when COVID hit. Yields, they plunged them, took them down to the ground. And so this is most likely started a new secular bull market in rates, which meshes with a new secular bear market to come. Again, whether that, that could take, maybe I'm wrong and it never breaks out, at least not in our lifetime. Sooner or later, all trends change over time. You're not going to have you can't go down. That secular bear market hit the ground, it hit near zero. And this is, 10-year, they hit zero, of course, from the federal funds rate and kept it there for a long time. But that's it. So whether we do this or whether we do this, when we do that, if and when that level's taken out. And again, that's what I do these videos for, day in, day out, just something to watch. Right now, we're not at an imminent or immediate risk of breaking that out. If we keep ticking up on the 10-year and keep ticking up on the 30-year, we'll be getting closer. Technically, I can make the case for it. I had a divergent low there, positive divergence. We broke out of this trading range in the 10-year, and we're still above it. So, okay, so back to the charts. I covered BIZD earlier today. Just wanted to update that and tell you that we have now broken down below there. So this is, not by mere coincidence. The markets are not doing well today. I mean, what is it? We had Palantir blow the cover off the ball last night. So what's the bad news? I don't know. Maybe there's a headline I missed, but I think that's it. That's probably it. And remember, this S&P 500 has not just a higher weighting. They have, financials is the second largest sector. And the NASDAQ one has virtually no financials, very little, if any. It's hardly measurable. So, so therefore, if the problems right now, which I see in again, more cockroaches in the BDCs, which are private credit, and look, and it's spilling over, as I told you, this is kind of an overlap, if you will, private equity, even though it's almost the inverse terminology to, you have equity as ownership, credit as debt, stocks and bonds, right? And this is private equity, but it's the same kind of shenanigans they're up to, where they get mark their portfolios and their loans, or their business ventures to market as to what they think it's worth. And again, remember, a lot of the same companies are also involved in private credit. So you can see private equity today. This is PSP, the private equity ETF, really going down, taken down. You can look at the individual holdings. This is Blackstone. former darling of Wall Street, but that peaked back here. You have to ask yourself, with the S&P 500 and Dow just recently punching out to new all-time highs, why is Blackstone, so far the early makings of a downtrend being lower lows and lower highs. We haven't made a new lower. If this low is taken out, then it will become more apparent to the masses. Right now, it could just be healthy consolidation. That's all. I could have to acknowledge that. But that's a pivotal low right there, about 117. That gets taken out. There's something else going on. KKR, these guys are coming down pretty heavy today. And this is just the private credit ones. Owl, Blue Owl. So the takeaway is, I think that the S&P 500, which has been much more resilient and outperforming QQQ relatively recently, and there's a trend line for it to break right there. Then my next level about 673.79. Then this is the lights out level for the S&P, the bottom of the trading range. I've been harping on these for months, to the point where many of you are probably getting tired of listening to these videos. But if and when that breaks, that's going to be a very powerful technical event, in my opinion. The NASDAQ 100, same trading range. Remember, we already hit T1. It's just a patience, pace kind of thing. And that gets taken out T2. But again, if T2's hit, the 200s will be taken out. I'm going to turn my focus to the longer term targets on the weekly chart. And those haven't changed for a while. T1, 2, 3, 4, 5, 6, 7, representing a drop of about, if hit, assuming if hit, 60% or so. And again, I do these long-winded videos to kind of how on God's green earth can that happen? Everybody, all the economic indicators are strong. Did you see the durable goods and this, that, and the other? And employment's kind of, soft, but it's, relatively off historic lows. Again, it's a lot of that, but a lot of that has to do with that margin bubble. If and when it pops and that vicious cycle begins, keep in mind what's kept the consumer, what's baffled most economists, myself included, is how resilient the consumer has been. Well, it's the wealth effect. Make no mistake about it. You can read about it. The central bankers, Fed chairmen have talked about it before, citing reasons for their cuts, including Bernanke and others, that they understand when they cut rates, they gun the stock market on purpose, and that creates consumer confidence. So consumers feel good about themselves. They see their 401ks going up, their stock portfolios, and they spend more. But when this pillar goes, if and when this goes, it's a vicious cycle. Consumer tucks in, businesses tuck in, businesses start to lay people off, consumers start to tighten their belt because their 401ks now drop 10, 15, 20, 30%. And the deeper it goes, the more that positive feedback loop happens. And you get down here, and I promise you're going to see that, again, we could do this first. So what I'm laying out, if that credit bubble or the margin interest bubble just continues to grow, because it hasn't shown signs of reversal yet, and it's not going to until the stock market buckles. Then when it does, that's when the selling will hit. So it all kind of comes in together, and then that's where you get these fast moves from. That's where silver can drop 30% in a day or within a 24-hour period. And the stock market can do similar, not 30 in a day. Stock market has circuit breakers that'll come into play, but it can certainly get to where it needs to go ultimately. So we wait and we watch. I'm certainly watching other sectors as well. Many other sectors. Capital markets, one of my favorites. I've told you Robinhood. I probably should have given you the price targets already. Just been one of my favorite shorts. And I think there's so much meat left on this bone. Only because it's the poster child of what happened at COVID with the armchair investors and those folks that decided they were going to take those stimulus checks and play meme stocks and buy crypto, and then the bull market hit. They could buy just about anything. There's that old saying, one of my favorite: never confuse genius with on your part with a bull market. All right, so all ships are lifting a rising tide. So then they load up. They think they got it figured out, and they're going to start trading for a living. And Robinhood is just Robinhood's not attracting the professional traders. They, zero commissions. They're selling your data. The exchanges, professional traders will go to like interactive brokers. Um, and there's the breakdown of the 200s. There was the divergent high with sell signal 1, 2, and it's already down. Remember, with the stock market just kissing new all-time highs, and Robinhood's down 44. And in my opinion, it's just getting going. I've shared these targets with you. My next target's 67.27, then the uptrend line. And then when I look at the weekly chart, um, and just knowing the makeup of their customer base, that will be basically 80-90% of them are just going to give up and go back to work and blow their accounts up when the next real bear market hits. And I'm right off highs in the S&P, so we're not there yet. And so this one I could see, from highs to low, this stock could drop 80-90% by the time the next bear market's over from the highs. A couple more. XLF, of course, financials. Still waiting for that break, solid break of the 53.10 level there. Failed breakout's already a check. I'm just trying to move that out of the way in my notes. Need to take out that 53.10 level, then the 200s, then 51.8. Our Novo today down big. They reported over in Denmark, and it had a perfect hit of T5. Remember, this was a swing trade taken down here initially. It was both a swing and a long-term trade. So I have long-term targets that's still in play. We fell, remember, just shy. When we hit T4, I told you I kind of wouldn't be surprised to see a retest of the recent lows. That's what we got. And then they gave us the juice to a perfect tag. Again, this was the T5. That level was given to you back on August 8th, right here. I'm going to put my crosshairs on August 8th, right there. Give you that fifth and final target for the swing trade of 63.95. And we hit the other day a high of 64.16, and then the next day we hit a high of 63.99. Close enough for government work. And then, all right. So it's a re-entry point here, especially if the market holds up. It should do well. This is the long-term trade idea. I gave you just two simple targets for what I call a trend trader. On the site, what I'm talking about is trade ideas. You have under these categories here, you have, let me grab my little drawing tool here. Oh no, I can't do that at the same time, but you can see here, let me zoom back, shrink the screen back. Trade ideas, you have long-term trades. It's not working with me right now because I'm doing the screen recording. I think that's confusing my little pop-up thing. But either way, that's what a long-term trade idea is. Get that little box gone. And that's it. So we already hit the first target off that entry, long-term support. We had a divergent low, another divergent low, went a little higher, and I still like it longer term. It's just right now. And if the market takes it hard, now again, it is a Danish company, but they have a big presence in the U.S. And I believe I heard today, I don't know if it's public info yet, but one of the key executive in the U.S. will be left the company, and that might have played into it as well. I haven't parsed through. I think they do their conference call tomorrow because they released their earnings over in Denmark, and they have such a presence in the U.S. I think they'll do their conference call tomorrow. All right, and then on the market, remember, Mr. VIX has woken up recently off that most recent divergent low. Divergent low there, went up, hit a quick 100%. These are still all potential targets. This is where corrections and bear markets end level. So if we are going to get, whenever the next correction comes, I think at minimum that's a very doable target. So a lot of meat left on that bone. Even from where we're at now, there should be another 226% up to there. On the weekly chart, like I've covered before, since the financial crisis, before the financial crisis, 2008, this is where bear markets would end. Then the financial crisis, which started in market peaked in October of 07 right there, bottomed in March of 09. This is where, and there was COVID, those two bear markets. And since then, this is where all the decent corrections would end too, including these last two. So these are all potential targets. And again, just, it continues to firm up after that most recent divergent low. And like natural gas lately and silver has the potential for explosive, very fast gains. It's the nature of the VIX. When she perks up, especially coming off these divergent lows, coming off support, that uptrend line should start creeping up a little as the market's starting to roll over. Then when the market starts breaking good support levels and I fire off my, the remaining, let's say that Alphabet shits the bed tomorrow night, that would certainly be a potential catalyst to see a quick spike up here to that, that same level we hit a couple times. If we keep tapping on this level. So if the markets break the support levels I'm looking at, the financials and the remainder of the Mag 8 stocks, then we're probably going to punch right on through there and keep going. And finally, I'll just give a wrap up on silver. So I gave you balanced target ranges today. Told you I still favor more downside in the coming weeks to months. Especially once this counter trend, what I view as a counter trend bounce off the initial drop, runs its course, and we hit the minimum of it this morning, and so far turned down there. So again, this is, so I try to be as precise as I can, but sometimes I have ranges. These ranges coincide with Fibonacci retracement levels, 61.8, 38.2, price resistance. There's a trend line right there if it wants to thrust up again and back test or not. Remember, parabolic uptrends, I say, don't end well. It's usually a very quick rush for that because you get that initial counter trend bounce. I already covered that in Friday's video, that we pretty much met the average, the norm on the counter trend bounce. Gold, I gave you bounce range 2. We hit the bottom of that range. We're still there now. So that's it. There's no guarantees. It's just, what the takeaway is, you can short here up to there, both on silver and gold, but not above. I also expect once this, silver is going to, I think has a lot more downside to go in gold. Again, I think they may have put in a more significant top. Just about everybody and their brothers is talking about a correction, great buying opportunity, and maybe that's the case. But I do think going forward now, or very soon, we're going to see gold either outperform or underperform less. Remember, I showed you that gold to silver ratio, which kind of troughed out recently about where it has historically. It does have potential for a little more downside, but I think the vast outperformance in silver over gold has come to an end most likely, because again, I showed you on that chart too, when the gold to silver ratio troughs out, that's usually when silver then it goes the other way. So that means gold starts outperforming silver. Alrighty, I guess that's about it. That's what I wanted to cover. You watch the financials. It's not just the BDCs. It's a big part of it. They're the ones really right now redlining. And then if they buckle and the market buckles, things I like are the broker dealers. IAI, I already showed you Robinhood being my favorite. This is IAI, the broker dealers index fund. It has all the big ones in there too, like Morgan Stanley waiting to break that trend line, Goldman Sachs, Schwab, bearish engulfing candle today so far in Schwab, coming off that divergent high. I'm going to tweak this trend. Oh, that was a valid trend line. I'll leave it there. That's a secondary trend line. S&P Global. Ooh, ouch. Look at that. 10% drop. CME waiting to break that trend line. Sell signal pending. ICE. Ooh, the exchanges are getting clocked today. And they have their own index too, but well, you can see them right now. I was going to type it in. Moody's, I mentioned this earlier. Boom, right down to support. Big drop there. 8%. It's off lows a little. Robinhood, again, one of my top picks in the coming foreseeable future. NASDAQ, oof, yeah, the exchanges just getting clocked today. And maybe that's a reflection. I'm sure it was I could see a little ease in here, earnings a couple days ago, but not today. That was a few days ago, it looks like. Yeah, 3-4 days ago. But maybe they're, those in the know are seeing what I'm seeing. If they see an imminent collapse of the debt bubble. And when that happens, again, it's just less trading volumes. Well, be trading volume, big trading volume on the way down, but they tend to fall with the market, even though there's a lot of trading volume. But what happens, because that just blows investors out of the game. And then when the dust starts to settle, there's just fewer people buying and trading, active trading in the market. Like I said, all those Robinhood accounts start blowing up. and they're doing a lot less business down the road. All right, guys, I'm going to stop here because I can keep going. You know me, get me talking about charts. I don't want to stop. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.